With stock market valuations pulling back from all-time highs, many investors are worried that we may be about to relive the year 2000, with another technology bubble, followed by another market crash. But the bigger risk is that the next crash could be far worse. Because when the dot-com bubble burst in 2000, the damage was largely contained within the stock market. Equity investors were badly burned as the Nasdaq fell nearly 80%. But the real economy kept functioning, and policymakers had plenty of room to cut interest rates and stabilize the system. Valuations may look similar today, but the real economy is very different. Unlike the speculative startups of the dot-com era, the companies driving today's AI boom are enormously profitable and deeply embedded across the economy. At the same time, governments are far more indebted and inflation remains elevated. So if markets do crash, the damage could spill much more freely into the real economy, while policymakers may find themselves far more limited in their ability to respond. But most worrying of all, those soaring asset prices may be telling us something even more unsettling about the financial system itself. Because the next crisis may not be about stocks at all. It may be about increasing distrust of the money and bonds that the government is issuing. But before we get there, let's look first at what is actually driving today's boom, how it differs, and how it's the same as the last one. Once again, in 2026, we are standing on the edge of a new industrial revolution. Artificial intelligence and robotics are now advancing at extraordinary speed. The economic opportunities are immense. So if the future looks so bright, what's the problem? Well, history shows us that every major technological revolution, whether it be steam engines or the internet, every leap forward has created enormous wealth. But the problem is that financial markets have a bad habit of getting ahead of themselves. And today's valuations suggest that may be happening again. According to Nobel Prize-winning economist Robert Shiller, one of the most widely followed measures of market valuation, the CAPE ratio, is now approaching levels seen only once before in modern history. March 1999, just 1 year before the dot-com crash began. Even then, many economists were warning that markets had become irrationally exuberant, but the warnings didn't stop the rally. In the following 9 months of 1999, the Nasdaq rose nearly 50%. Then, in just a few short months, it surged another 50%, doubling before finally peaking in March 2000. It was an extraordinary final burst of optimism. And then the collapse began. Investors who bought shares a year earlier, in March 1999, at levels comparable to today, eventually lost roughly half their wealth. Those who bought near the peak lost closer to 80%. The remarkable thing is that investors were right to believe in 2000 that we were on the cusp of a new industrial revolution. The internet really did transform the global economy, but investors made two critical mistakes. They overestimated how quickly profits would appear, and they underestimated how difficult it would be to identify the eventual winners. Today we are seeing very similar signs of exuberance, even though it's very possible that artificial intelligence could be even more transformative than the internet. The problem is that technological success does not automatically lead to investment success. Technological breakthroughs tend to unleash waves of experimentation, competition and failure before the eventual winners emerge. Technological revolutions do create enormous wealth, but they also destroy enormous amounts of capital along the way. And that is why the current situation looks risky and fragile. Because if expectations prove to be too optimistic, then valuations will have to adjust sharply. And this time, the consequences could spread much further. Despite the extraordinary destruction of wealth when the dot-com bubble burst in 2000, the real economy held up surprisingly well. By 2002, the Nasdaq composite had fallen 80%. Thousands of technology firms vanished, venture capital dried up, and investors lost trillions of dollars. But the broader economy slowed only modestly. Economic growth weakened, but it did not collapse. Unemployment rose, but only gradually. Global trade continued expanding. Inflation remained subdued. And although there were bankruptcies in the technology sector, the financial system itself remained largely intact. Why? Part of the answer lies in the structure of the bubble itself. The dot-com boom was driven largely by speculative startups with little revenue and almost no profits. Many were funded primarily through equity markets rather than large amounts of debt. When their share prices collapsed, the losses were mostly absorbed by investors rather than transmitted through the banking system. Today, the situation looks very different. The boom surrounding artificial intelligence is tied far more deeply to the real economy. Unlike the startups of the late 1990s, today's AI expansion is being driven by some of the most profitable corporations in the world. Companies such as Nvidia, Microsoft, and Alphabet are generating enormous profits while simultaneously investing staggering amounts of capital into artificial intelligence infrastructure. This includes vast networks of data centers, advanced semiconductor manufacturing, specialized chips, and the energy systems required to power them. The AI boom is therefore not just financial. Billions of dollars are being spent on real factories, real equipment, and real infrastructure. That creates a far deeper link between financial markets and the industrial economy than existed during the dot-com era. If technology valuations were to collapse and investments slowed, the ripple effects could spread quickly through manufacturing, construction, and energy sectors. Another important factor is the broader macroeconomic environment. Government debt levels in the United States in 2000 were relatively modest. Fiscal deficits were small, and for a brief period, the federal government was even running budget surpluses. That meant policymakers had plenty of room to respond if growth slowed. Today, that room is far more limited. Public debt levels across the developed world are dramatically higher than they were at the turn of the millennium. Years of fiscal stimulus following the global financial crisis and the pandemic have left governments with far less flexibility if growth falters. Large structural deficits and rising interest payments mean governments may struggle to deliver stimulus on the same scale seen during previous downturns. Another issue is inflation. Back in 2000, inflation was low and trending downwards, giving the Federal Reserve significant flexibility to cut interest rates aggressively. Between 2001 and 2003, the Fed slashed rates from 6.5% to just 1% in an effort to support the economy. Cheap credit helped stabilize housing markets, encouraged borrowing, and eventually helped fuel the next expansion. Today, however, inflation remains a far more persistent risk than it was in the early 2000s. Central banks cannot assume that aggressive rate cuts will automatically stabilize the economy without potentially reigniting price pressures. That creates a far more delicate balancing act for monetary policy. Consequently, in 2000, policymakers could draw on a number of powerful shock absorbers. The stock market crashed, but the government and the Federal Reserve stepped in and kept the broader economy moving. Today, the economic shock absorbers and safety nets are far thinner. If a crash occurs, the shock could spread quickly from Wall Street into the real economy. And that raises an uncomfortable possibility. What if the market isn't climbing because investors are optimistic, but because they're afraid? They are not buying stocks because they think they are good value. They are buying them because they are losing confidence in money. They are afraid that money itself is losing value. If that is the case, then the stock market rise is due to the Tina effect. There is no alternative. When the Tina effect takes hold, stocks become an inflation hedge, not an investment, a way to escape currency debasement rather than participate in real economic growth. And if that's what's really driving markets today, then we may not be watching the build-up to another crash. We may be witnessing something far more dangerous, the gradual erosion of confidence in money itself. And when confidence in money starts to erode, the effects don't stay confined to Wall Street. They spread fast into the real economy. Credit dries up. Governments suddenly find that investors demand higher and higher yields just to buy their bonds. Companies can't refinance their debts. Banks tighten lending, and households face soaring mortgage and credit costs. Then investment collapses. Hiring freezes, layoffs spread, and as confidence drains away, so does growth. Meanwhile, the cost of living keeps rising, not because the economy is strong, but because the value of money keeps falling. Wages can't keep up. savings lose value, and ordinary people start to feel poorer even as stock indices hit new highs. That's how a melt-up is even worse than a meltdown. It's a terrible example of when a financial problem turns into a social one, when the loss of faith in money seeps into every corner of daily life. And if that cycle takes hold, the next crash won't just hit portfolios, it'll hit every part of the economy: jobs, homes, and even the stability of the system itself. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.